Welcome everyone, and thank you for joining today's presentation. My name is Marlee Stever, and I'm a senior counsel here at Tully Rinckey. My primary practice areas are estate planning, trust administration, probate administration, guardianships, and estate tax matters. Today's presentation will be on estate planning in a world shaped by the Secure Act and Secure 2.0. Our goal today is to break down the major changes to retirement account distribution rules and how they affect estate planning strategies. The Secure Act stands for Setting Every Community Up for Retirement Enhancement. It was enacted in 2019 and significantly reformed retirement rules. Secure 2.0 was passed in 2022 and built on that foundation. Key goals of the legislation is to encourage Americans to save more for retirement, expand access to retirement plans, and to accelerate tax revenue by shortening deferral periods for inherited IRAs. For estate planners, the Secure Act marked the end of the quote-unquote stretch IRA for most beneficiaries and forced a reevaluation of many common planning strategies. Before we get into the key provisions, let's start with the three terms that shape everything we'll be discussing. Those three terms are required minimum distribution, designated beneficiary, and eligible designated beneficiary. What is a required minimum distribution? A required minimum distribution is the minimum amount a retirement account holder must withdraw each year once they reach a certain age. Prior to the Secure Act, RMDs began at age 70 and a half. The Secure Act increased the RMD age to 72, and then Secure 2.0 further increased it to 73 for those born between 1951 and 1959. For anyone born in 1960 or later, RMDs begin at age 75. RMDs apply to traditional IRAs, 401ks, and similar pre-tax retirement accounts. Roth IRAs, which are post-tax retirement accounts, are excluded. They do not have RMDs during the original owner's lifetime. Failure to take an RMD can result in a penalty which used to be 50%, but has been reduced to 25% and potentially 10% if corrected in time under Secure 2.0. What is a designated beneficiary? A designated beneficiary is an individual named as a beneficiary of a retirement account. A DB cannot be an entity like a charity, trust, or estate. Designated beneficiaries are eligible for the 10-year rule under the Secure Act unless they also meet their criteria to be an eligible designated beneficiary, which we'll define next. On the other hand, non-designated beneficiaries include estates, charities, and non-see-through trusts. These non-designated beneficiaries cannot stretch distributions and are instead subject to either a 5-year rule if the owner died before starting RMDs, or the remaining life expectancy method if the owner died after RMDs. Life expectancy is based upon the decedent's life, not the inheriting beneficiary. Some examples of a designated beneficiary. So Alice names her son, Mark, as a beneficiary. Mark is a designated beneficiary. However, if Alice's estate is the beneficiary, it's a non-designated beneficiary and could be eligible to that 5-year rule. Who is an eligible designated beneficiary? An eligible designated beneficiary is a special category of DB who may still stretch distributions over their life expectancy instead of using the 10-year rule. Under the Secure Act, eligible designated beneficiaries include the surviving spouse, a minor child of the account owner, though only until they reach the age of majority, a disabled individual, a chronically ill individual, or an individual not more than 10 years younger than the decedent. Some examples: Alice names her disabled daughter as the beneficiary. The daughter is an eligible designated beneficiary and qualifies for life expectancy distributions. Another example, Alice names her 35-year-old sibling, who is only 7 years younger. That sibling also qualifies as an eligible designated beneficiary. However, if Alice names a friend who is 25 years younger, that person is just a designated beneficiary. So what was the Stretch IRA? The Stretch IRA was a popular planning tool that allowed beneficiaries to quote-unquote stretch distributions from inherited retirement accounts over their own life expectancy. The benefits were smaller annual RMDs, continued tax-deferred growth, and more control over taxable income. Secure Act eliminated the Stretch IRA for most non-spousal beneficiaries. Key Secure Act changes. I've provided a summary here of what those changes are, and we'll also go over them in a little bit more detail next. But so the RMD age increased to 73 and will rise to 75 for those born in 1960 and later. The 10-year rule now applies to most non-spousal beneficiaries. Only eligible designated beneficiaries can use the life expectancy method, and many trusts previously used to stretch distributions no longer work as intended. Penalties for RMD failures were also reduced. So distribution rules after death. The rules for post-death distributions now depend on whether the beneficiary was a designated or non-designated beneficiary, and 2, whether the owner died before or after the required beginning date. The required beginning date is April 1st of the year after the account owner turns 73 or 75, depending on their birth year. Here's a simplified breakdown. Designated beneficiary uses the 10-year rule unless they qualify as an eligible designated beneficiary. Non-designated beneficiaries, if the owner died after the required beginning date, 5-year rule applies. Sorry, if the owner died before the required beginning date, the 5-year rule applies. If the owner died after the required beginning date, distributions are over the owner's remaining life expectancy. So say if the owner was very old, then you might have to distribute out the retirement account within, say, 4 years instead of 5 years. So it can change. The 10-year rule. The 10-year rule is one of the most important changes under the Secure Act. And here's how it works. The inherited account must be fully distributed by December 31st of the 10th year following the year of the owner's death. There are no required minimum distributions during the 10 years unless the owner died after the required beginning date. So after they turn 73 or 75, depending on their birth year. This rule can lead to lump sum tax consequences if planning is not done properly. There are no required minimum distributions during the 10 years unless the owner died after the RMD. So the 5-year rule applies when a non-designated beneficiary inherits the account and the owner died before the required beginning date. Under this rule, the entire account must be distributed by December 31st of the 5th year after the account owner's death. there are no annual distribution requirements until the end of the 5-year period. However, if the owner died after the required beginning date, then the non-designated beneficiary must use the remaining life expectancy of the owner. So spouses are the most flexible class of beneficiaries when it comes to inherited retirement accounts. They can, 1, roll over the inherited IRA into their own IRA, or 2, remain the beneficiary of the inherited IRA. Remaining the beneficiary is especially useful if the surviving spouse is older than the deceased. This delays RMDs until the deceased spouse would have reached the required beginning date. You can also use the joint life expectancy tables for RMDs, and you can use this table instead of the single life table, which has much smaller timelines for payments. Because of these options, spouses often benefit from working with an advisor to determine the optimal strategy based on age, income, and tax considerations. So Roth IRAs and required minimum distributions. Roth IRAs offer unique benefits to estate planners. For the original account holder, there are no lifetime RMDs, making them great for leaving tax-free assets to heirs. However, beneficiaries of Roth IRAs must still follow the 10-year rule unless they qualify as an eligible designated beneficiary. The distributions are income tax-free, assuming that the account has been open for at least 5 years, and there is no requirement to take annual distributions during the 10-year window. So the Roth can continue growing tax-free until the 10th year when the full balance must be withdrawn. Because of this, Roth conversions during lifetime are a powerful strategy to reduce tax burdens for heirs. So trusts as beneficiaries. Trusts can still be used to control inherited retirement assets, but the Secure Act significantly changed how they function. There are 2 main types of trusts, typically referred to as see-through trusts. Those trusts are called the conduit trusts. This trust pass all IRA distributions directly to the trust beneficiaries. Under the Secure Act, conduit trusts are subject to the 10-year rule unless the beneficiary of the trust is an eligible designated beneficiary. The accumulation trusts allows the trustee to accumulate IRA distributions instead of passing them outright to the beneficiary. However, accumulated distributions are taxed at the trust income tax rate, which is the top bracket is 37% at just $15,000 of income. We use accumulated trusts when a beneficiary of the estate is a minor, or for debt protection, or if a beneficiary is a potentially disabled beneficiary. If the beneficiary of the trust is an eligible designated beneficiary, such as a disabled person, the trust may still qualify for life expectancy payouts, but only if it is properly drafted as a see-through trust. So tax implications of the 10-year rule. The shift to a 10-year withdrawal period significantly accelerates income taxation for many beneficiaries. Some key considerations are distributions that would have been spread out over potentially 30+ years must now be taken out in 10 years. Large lump sum withdrawals can push beneficiaries into higher tax brackets. Planning is essential to smooth out distributions, especially for working age beneficiaries who may already have high incomes. So Roth conversions and other planning tools. Roth conversions are one of the most effective tools in post-secure environment. Why? They put taxes now at a potentially lower bracket. They pay taxes now at a potentially lower bracket. They allow for tax-free growth. Beneficiaries can inherit Roth IRAs with no tax liability, even though they must be emptied within that 10-year period. So, post-mortem planning opportunities. After the account owner's death, some planning opportunities still remain, especially before September 30th of the year following the death. This is known as the beneficiary finalization date. What can happen before September 31st? So we can do disclaimers. A named beneficiary can disclaim all or parts of their interests, allowing it to pass to contingent beneficiaries. We can do splitting accounts among multiple beneficiaries to preserve more favorable treatment. And then timing distributions to coordinate with income tax or tax brackets of the beneficiaries. It's important to consult with both estate and tax professionals early in the year following the death to take full advantage of these strategies. Let me just turn on my light real fast. So, excise taxes and missed RMDs. If a required minimum distribution is missed, the IRS imposes an excise tax. Prior to Secure 2.0, the penalty was 50% of the amount not withdrawn. Secure 2.0 reduced the penalty to 25% and further down to 10% if the mistake is corrected within the correction window. To request a waiver or report the penalty, you should use IRS Form 5329. Even under the 10-year rule, if the account owner died after their RMD, annual RMDs are required in years 1 through 9, and failure to take them can trigger this penalty. So a beneficiary after the original account owner's death, they do have to still make those required minimum distributions if the 10-year rule applies, and if the owner died after the required beginning date. Okay, so final action steps. To close, here are a few items that estate planners and clients should consider in light of the Secure Act. You should review all retirement account beneficiary designations to ensure that they are up to date and consistent with the estate plan. You want to revisit any trusts designated as an IRA beneficiary to confirm they still function as intended under the Secure Act. And you should educate clients on the impact of the 10-year rule and the tax acceleration it causes. And we can use tax planning tools such as Roth conversions to offset loss of the stretch, and to also monitor future IRS guidance and legislative changes. All right. And that is it for today. Any questions?
Was there a penalty that was waived from 2020 to 2024 for not taking RMDs?
Was the penalty waived for 2020 to 2024 due to the changes in the law? So I don't believe those would have been waived during that period, though I can look up. I'm actually unsure about whether or not those penalties were waived while they're in between the changes of the Secure Act and then Secure 2.0. Is the question whether or not a special needs trust would need to be a non-designated beneficiary, even though this special needs person would be an eligible designated beneficiary? So the question is whether a special needs trust would need to be a non-designated beneficiary, even though the special needs person would be an eligible designated beneficiary. So I would suggest actually in the special needs trust to include language that would help payments, or it would potentially include an accumulation trust, which would hold on to the retirement assets during the special needs use of that trust, so that it would qualify for the eligible designated beneficiary as an eligible designated beneficiary under the Secure Act. So the special needs trust should be drafted as to still allow for qualifications as an eligible designated beneficiary. So if you marry a partner just before they pass, are there any downsides to doing so? I would not be able to say off the top of my head. For the Secure Act, it would make it easier to inherit. So you would still be eligible even though you married close to them passing. But I wouldn't know about any other downsides, at least in regards to the Secure Act. Another question is, if you're receiving an inheritance, should you invest the inheritance in an IRA? So I would suggest talking with a financial advisor about what best to do with the inheritance. An IRA is a good financial tool for income growth. So I would say that it could potentially be a good thing to do, but I would definitely talk with a financial advisor. So depends on how old the son is. So, sorry, the question is, if a person receiving RMDs dies, leaving son as beneficiary, son must receive the entire distribution within the 10-year period. So yes, the son would have to receive the distributions within the 10-year period, unless the son is a minor. So with regard to that question as well, the son would have to also make sure to make those required minimum distributions during the first 1 to 9 years. Another question regarding conduit trusts, which names a disabled person as the primary beneficiary. It is clear that the trust qualifies for the lifetime stretch. However, is the lifetime stretch affected if trust names a non-disabled person as the remainder beneficiary? So the beneficiary to inherit the remaining proceeds of the trust upon the death of the disabled party. So the lifetime stretch would be affected if the non-disabled person is the beneficiary of the retirement asset. It also depends on whether or not that non-disabled person qualifies for any of the other, yes, Secure Act eligible designated beneficiary. But if that individual does not, then they would be subject to the 10-year under the trust and the conduit trust.
So I want to thank everyone for joining today's webinar, and thank you again, Marlee, for presenting. Today's presentation was recorded, and a copy will be sent to all attendees later next week. Thank you, and have a great rest of your day.
Thank you.